Something happened in the last 72 hours that the financial media is desperately trying to bury. And I'm not talking about one story, I'm talking about 4 separate confirmations that just validated everything this channel has been telling you for months. By the time you finish this video, you're going to understand why the United States government just admitted that silver prices are artificially low. You're going to see the actual SEC filing that proves Hecla Mining is receiving 30% more than the COMEX price for their silver. And you're going to read the exact words from the CEO of America's largest precious metals dealer, admitting that the physical silver market just experienced something unprecedented. But here's the part that's going to make you angry. While these 4 stories were breaking, the mainstream financial media was talking about everything except this. They were covering celebrity scandals. They were debating interest rates. They were doing everything possible to keep your eyes away from the single most important development in the precious metals market in the last decade. Let me be clear about what just happened. The United States government has officially confirmed a price floor system for critical minerals, and silver is on that list. This isn't speculation. This isn't rumor. This is documented policy being pitched to 55 allied nations as we speak. Let me start with the biggest story because this one changes the entire game for every silver investor, every silver miner, and every person holding physical metal. Bloomberg reported that Undersecretary of State Jacob Hellberg confirmed that multiple U.S. agencies have developed a critical minerals price floor system. The system is designed to prevent market manipulation from hostile nations, specifically China, from driving prices below sustainable levels for Western producers. But this didn't appear out of nowhere. Let me give you the timeline that nobody else is connecting. On February 4th, Vice President J.D. Vance stood at the State Department in front of representatives from 55 countries. This was the Critical Minerals Ministerial, one of the most important economic gatherings of the year. And what he said should have been front-page news everywhere. He said the United States will establish reference prices for critical minerals at every stage of production. He said that for members of what he called the preferential zone, these reference prices will operate as a floor. And he said this floor will be maintained through adjustable tariffs to uphold pricing integrity. Let me translate that into plain English because the implications are enormous. The United States government is telling the world that certain minerals, including silver, will have a minimum price, a floor, a level below which the price cannot fall within the allied trading bloc, and they're backing this floor with tariffs, meaning if anyone tries to dump cheap silver to crash the price, they'll face tariffs that make it economically impossible. This is not a suggestion. This is not a proposal being debated. The EU has already agreed. Japan has already agreed. Mexico has already agreed. 11 countries have signed bilateral agreements. And on that same day, Trump unveiled Project Vault. Project Vault is a $12 billion critical minerals reserve, $10 billion from the U.S. Export-Import Bank, $2 billion from private funds. The purpose is to stockpile strategic minerals and stabilize prices. When I first read the details of this announcement, I had to read it 3 times because the implications for silver are almost too bullish to believe. Think about what this means. A price floor means the U.S. government is essentially saying we will not allow the market to price silver below a certain level. That's not free market economics. That's strategic economic intervention. That's the government picking a side, and the side they picked is the side of physical metal holders. The fact that 55 countries are sitting at the table tells me this is much bigger than anyone realizes. This isn't just about silver. This is about restructuring the entire global commodities market to remove China's pricing power. Now let me connect this to what's happening with silver specifically. The U.S. government has now officially acknowledged that the free market price of critical minerals is broken. They're saying that China's dominance in processing and refining has distorted prices to the point where Western companies cannot compete. And the solution is not to let the market figure it out. The solution is to intervene and set a floor. This is the most bullish policy development for silver in decades, and I'm not using that word lightly. Because if silver has a government-backed price floor, every single ounce you hold has a backstop. The government is telling you that your silver will never fall below a certain level within this trading block. That changes everything for miners. That changes everything for industrial buyers. That changes everything for anyone holding physical metal. And here's the part that should make you sit up straight. This announcement came out while silver was trading around $74 after the biggest crash in 46 years. The U.S. government looked at silver at $74 and said the market price is broken. It's too low. We need to put a floor under it. Read that again. The government of the United States is telling you that the current price of silver is artificially low. Now this is where it connects to everything I've been showing you on finance currency about China's silver export controls. 44 companies licensed, Silver reclassified as a strategic material on the same regulatory footing as rare earths. Export restrictions tightening every month. What Vance is doing with the price floor is the Western response to China's export controls. China is restricting supply. The U.S. is guaranteeing price. Both actions point in the same direction. Silver is going higher. The only question is how much higher. And if you're wondering whether silver is actually included in the critical minerals list, let me remove all doubt. The Section 232 investigation concluded that imports of processed critical minerals threaten to impair national security. Silver is used in every advanced weapon system, every solar panel, every semiconductor, every piece of military hardware the United States produces. Silver is definitionally critical, and now it has a government-backed floor. This is finance currency. If you're new here, subscribe and drop a like. One click from you helps thousands more see this information. Let's keep going because the next story proves everything I just told you from an entirely different angle. Now let me show you what Hecla mining just revealed, because this is the proof that the paper silver market has already separated from the physical silver market, and it's sitting right there in their SEC filing for anyone willing to actually read it. Hecla Mining Company released their fourth quarter and full year 2025 results, and the numbers are absolutely staggering. Revenue over $1.4 billion. That's up 53% from last year. Net income, $321 million. That's 9 times more than 2024. Let me say that again. 9 times more profit in 1 year. These are the best numbers in Hecla's entire 135-year history. This is a company that has been mining silver since 1891. They've seen every market cycle, every crash, every bull run, and 2025 was their best year ever. I've analyzed a lot of earnings reports over the years. A 9 times increase in net income is not normal. That doesn't happen in normal market conditions. That's what happens when an entire market reprices around you and you're sitting on the supply side. But those aren't even the numbers that matter most. This is. The average silver price for the fourth quarter of 2025 was $54.83. That's the market average, the benchmark price. What COMEX said silver was worth. Hecla's average realized silver price in the fourth quarter was $69.28. Let me make absolutely sure you caught that. The market said silver was 54.83. Hecla got 69.28. That is a $14.45 premium, nearly 30% above the average market price. This wasn't in Shanghai. This wasn't in some underground deal. This was in America. From America's largest silver miner, reported to the SEC, on the record, audited, verified. That's not a rumor. That's a financial statement. Now, here's the question you should be asking. How does a mining company realize a price that is 30% higher than the market average? There are only 2 possible explanations. Explanation 1 is that Hecla held back production and sold everything in late December when prices spiked higher. That would mean they were timing the market rather than selling steadily throughout the quarter. That's possible but unusual for a company of this size. Major miners typically sell consistently to manage cash flow. Explanation 2 is that industrial silver buyers are going directly to silver mines and paying a premium to secure physical supply. They're bypassing COMEX entirely because they need actual metal for manufacturing and they cannot rely on the exchange to deliver it. I believe it's the second explanation. And here's why. We already know Samsung locked up 100% of the output from the La Pria silver mine for 2 years through a direct prepayment deal. They didn't go to COMEX, they went straight to the mine. We already know that London lease rates hit 34.9% in October because institutions were desperate to borrow physical silver. That's not normal, that's panic. We already know that Shanghai physical silver trades at a 20% premium to paper silver. The Chinese market has already separated from COMEX pricing, and now we have the largest silver miner in North America reporting a 30% premium on their realized price. This is not a coincidence, this is a pattern. Industrial buyers are going around COMEX. They're going directly to the source because the exchange cannot guarantee delivery. And when buyers are willing to pay that kind of premium to get silver directly from mines, that tells you everything about where the real price of silver actually is. The real price is not what COMEX says it is. The real price is what someone will actually pay to get their hands on physical metal. And right now, that price is far higher than the ticker on your screen. This connects directly to what I've been showing you about the Shanghai premium. Physical silver in China trading at 99 while COMEX says 74. Now we have a US miner confirming the same pattern from the supply side. The mines are getting more than the market price because the market price is wrong. The CEO of Hecla called 2025 transformational. Think about that word, transformational. A year ago, they were carrying hundreds of millions in debt. Now they're essentially debt-free. Silver did that in 1 year. But here's the move that tells you what the smartest people in silver are actually thinking. Hecla is selling their gold mine for almost $600 million to go all in on silver. Gold is at $5,000. And they're selling the gold mine to buy more silver exposure. Let me say that again because I need you to understand what this means. The largest silver miner in North America is choosing silver over gold at $5,000 gold. These people literally pull metal out of the ground for a living. They have 135 years of experience. They have geologists and engineers and market analysts. And they are making the biggest bet of their corporate lives on silver going higher. Their 2026 guidance calls for 15 to 16.5 million ounces of silver production. They're nearly doubling exploration spending to $55 million. They see something. And their cost structure tells you why they're this confident. All-in sustaining cost is $18.11 per ounce. Realized price is $69.28. That's a $51 margin on every single ounce. That's 74% margin. Their Greens Creek mine in Alaska reported a negative cash cost after byproduct credits. Negative. They're literally getting paid to mine silver. That's how profitable this is. When the people who know silver better than anyone on the planet are making moves like this, you should pay attention. And what they're telling you through their actions is that the current COMEX price is a fiction. The real market is somewhere else, and the real price is much higher. Now let me show you what the CEO of APMEX just admitted, because this confirms everything from the retail demand side. This story is personal, because some of you watching right now lived through exactly what I'm about to describe. And the CEO of America's largest precious metals dealer just put it in writing. Ken Lewis, the CEO of APMEX, published a letter to customers on February 17th. And I want to read you the exact words because the language he used tells you everything. He said, "Shipping times and customer service levels have returned to the fast, reliable standards you expect and deserve." Sounds like good news, right? Problem solved. Shipping is back to normal. But let me read you what else he said. He thanked customers for their patience, understanding, and trust during what he called one of the most extraordinary periods the precious metals market has ever seen. He said they experienced unprecedented demand, record prices, and supply challenges that put pressure on the entire industry. Let me put this in context so you understand exactly what he's admitting. APMEX is the largest online precious metals dealer in the United States. They've been doing this for decades. They have massive warehouses. They have minting operations. They have relationships with every major mint and refiner on the planet. And for roughly 1 month, they could not ship silver on time. They added 4 extra business days to every estimated ship date. They reduced their product selection to 31 core products, and they could only keep 21 of those in stock. They increased customer service headcount by 25% just to handle the call volume, and they experienced weekend order volumes that were 7 times higher than normal. 7 times normal volume on weekends. Think about what that means. This is the largest dealer in the country. Decades of experience. Infrastructure built for scale. And they were completely overwhelmed for an entire month. Some of you watching right now know exactly what I'm talking about. You placed an order in January and waited weeks. Some of you emailed me asking what was going on. Some of you may still be waiting for orders from other dealers. If that doesn't tell you the physical silver market broke, I don't know what will. Now here's the question I want you to think about carefully. If APMEX is back to normal now, is it because supply caught up with demand? Or is it because the 46% price crash scared enough buyers out of the market that demand temporarily dropped? I think it's the second explanation, and the APMEX letter actually proves it. The letter says many firms across the industry are still working through supply constraints and service challenges. Other dealers haven't caught up yet. Only APMEX is back to normal. The smaller dealers are still struggling. And look at the timing. The crash happened on January 30th. APMEX says they're back to normal on February 17th. That's 18 days. 18 days for the largest dealer in America to clear their backlog after a massive price crash temporarily killed buying pressure. So here's what I want you to understand about the cycle. What happens when silver starts running again? When prices recover? When the next wave of buying hits? If it took APMEX a full month to catch up after a crash reduced demand, what happens when demand comes back? The answer is the same thing that happened before. Delays, shortages, premiums, and the cycle starts all over again. But each time the cycle repeats, the structural situation gets worse. The deficit keeps running, the inventory keeps draining, the vault keeps getting emptier. We're at the part of the cycle where dealers just caught up, which means we're about to enter the part where demand returns. And this time the vault has less silver than last time. I also want you to notice the specific language Ken Lewis used. He called this period one of the most extraordinary the precious metals market has ever seen. This is the CEO of the largest precious metals dealer in America, a man who has seen every market cycle for decades, every bull run, every crash, every squeeze, every panic. And he's calling this the most extraordinary period ever. That's not the language of someone who thinks it's over. That's the language of someone who knows what's coming next and is getting his operations ready for round two. The fact that APMEX had to write this letter at all is the story. A CEO does not publish a letter saying, please be patient, we can't ship your silver during normal market conditions. This letter exists because the physical silver market broke for a full month, and they're telling you it's fixed now. But the structural shortage that caused it hasn't changed. The deficit is still running. The inventory is still draining. The demand from industrial buyers is still growing. Solar installations are accelerating. EV production is scaling. AI data centers need more silver for connections. Military spending is increasing. None of that changed because of a price crash. The crash didn't add one single ounce to the vault. It just scared some retail buyers out of the market temporarily. That's it. That's all it accomplished. And now those retail buyers are seeing silver recover from 64 to 78 in 3 weeks. They're seeing the government announce a price floor. They're seeing Hecla report record profits. And they're going to start buying again. When they do, APMEX is going to have to write another letter, and next time the delays might be longer, because the vault will have even less silver than it did before. This is what I mean when I talk about the physical market replacing the paper market. The paper market can crash prices 46% in a day, but it can't manufacture silver, it can't fill dealer warehouses, it can't satisfy industrial demand. All it can do is create temporary dislocations that smart money uses to accumulate more. Now let me show you the fourth piece, the one that connects everything to February 27th. There are currently approximately 35,000 call options on March 2026 COMEX silver futures that are in the money right now. These are options that give the holder the right to buy silver futures at prices below where silver is currently trading. They are profitable, and the banks cannot do anything about it. Let me explain why this matters and why February 27th is the date circled on every trading desk at every bullion bank. Traditionally, the bullion banks try to slam the silver price before options expiration. The goal is to prevent as many calls from expiring in the money as possible. If they can crash the price below the strike prices, those options expire worthless, and the banks keep the premium. We saw this happen on January 30th. They crashed silver from 121 to 64 in a single session. That was the slam. That was the attempt to knock every call option out of the money and break the back of the silver rally. And it didn't work. Even after a 46% crash, the most violent single-day move in 46 years, 35,000 calls are still in the money. The banks lost control of the silver price to such an extent in January that even their most extreme intervention couldn't kill enough options to matter. Silver has recovered from 64 to 78 since that crash, and every dollar it recovers, more calls come back into the money. The options that were knocked out at 64 are profitable again at 78. The strike prices that looked dead are alive again. Now here's the scenario that should keep every bullion bank awake at night. What happens if a significant portion of these in-the-money call option holders exercise their calls? If they exercise, they receive a long March silver futures contract. And if they then stand for delivery on that contract, they are demanding physical silver from COMEX, real metal, not cash settlement, not rolled to the next month, actual silver bars in the vault. The same COMEX vault that has 98 million ounces of registered silver against over 400 million in open interest. This is the scenario I've been warning about on finance currency. The crash was supposed to wipe out the calls. It didn't. The crash was supposed to reduce delivery demand. It didn't. February deliveries are running at 98% fulfillment rate, and now 35,000 calls are sitting in the money with 9 days until first notice day. Let me put a number on this so you understand the scale. Each COMEX silver futures contract represents 5,000 ounces. If 35,000 call options are exercised, that would represent 175 million ounces of potential delivery demand. The vault has 98 million ounces registered for delivery. Even if only a fraction of these calls are exercised and stand for delivery, the math does not work. The vault doesn't have enough metal to satisfy the demand. Now the obvious question is, will all 35,000 options be exercised? No. Most options traders close for cash. They don't actually want the metal. They're trading paper for profit. But here's what's different this time. We are in an environment where industrial buyers desperately need physical silver, where Samsung is locking up entire mines through direct prepayment deals, where Hecla is getting 30% premiums from direct buyers, where Shanghai physical silver trades at 20% above paper, where APMEX couldn't ship for a month because they ran out of inventory. In this environment, the incentive to exercise and take delivery is higher than at any point in modern history, because think about the arbitrage opportunity. If you can get COMEX silver at $78 through an exercise call option and immediately sell it to an industrial buyer who's willing to pay $90 or $100, you're printing money. The spread between paper and physical is free profit for anyone who can take delivery. Smart money knows this. Funds that have the logistics capability to actually take silver bars out of the vault and deliver them to industrial buyers are doing exactly that. And every ounce that leaves the vault for industrial use is an ounce that's never coming back. This is the mechanism by which the paper market dies, not through some dramatic event, through the slow, steady drain of physical metal from the vault as the spread between paper and physical makes delivery increasingly attractive. The vault started this cycle with 400 million ounces of total inventory. It's now down to 98 million registered. That's a 75% decline in the metal actually available for delivery. And on February 27th, we get to see how many of those 35,000 call options exercise, how many stand for delivery, and whether the vault can survive another drain. I want you to think about the position the banks are in right now. They crashed silver 46%, and it didn't kill the options. They used every weapon in their arsenal, and the rally survived. Silver is already back to 78 and climbing. The U.S. government just announced a price floor. Hecla just reported that the real price is 30% higher than COMEX. APMEX just admitted the physical market broke for a month, and they have 35,000 in-the-money calls staring them in the face. What are they going to do? Crash it again? They already tried that. It didn't work. The calls are still in the money. The shorts are still trapped. The vault is still draining. This is what happens when a market manipulation scheme runs into a physical supply shortage. The manipulators can move prices on screens, but they can't manufacture metal. And eventually the screens have to reconcile with reality. February 27th is a reconciliation date, not the final one, but an important one, and I'll be covering it live on Finance Currency as it unfolds. I want to connect all four of these stories for you now, because separately, they're interesting. Together, they tell you everything. And honestly, this is the part that gets me fired up, because when you lay it all out, the picture is so clear that I cannot understand how the mainstream financial media isn't screaming about this every single day. Here's what nobody else is putting together. The price floor is the U.S. government admitting that the market is broken. They looked at silver prices and said, these are artificially low. We need to intervene. That's not my interpretation. That's literally what the policy does. Hecla's numbers prove the market is broken from the supply side. The largest silver miner in North America is getting 30% more than the COMEX price. That means buyers are bypassing the exchange and paying premiums directly to the source because they don't trust COMEX to deliver. APMEX's month-long crisis proves the market is broken from the demand side. The largest dealer in America couldn't ship silver for a month. They ran out of inventory. They had to write a letter apologizing to customers for delays during what they called the most extraordinary period ever. And 35,000 in-the-money calls prove the market is about to be tested from the delivery side. February 27th will show us whether COMEX can survive another drain. 4 different angles: supply, demand, policy, and market structure. And all 4 are pointing in the exact same direction. The paper silver market is dying, and the physical market is replacing it in real time. Now let me tell you what I think this means for prices. And I want to walk you through what's happening as I record this for Finance Currency. Gold has recovered to $5,000. It touched $4,900 earlier this week and bounced hard. The recovery is happening because the market is digesting the price floor news. When the U.S. government tells 55 countries that critical mineral prices need a floor, capital starts flowing back into the metals that were just crashed. Silver is back to 78. It bottomed at 64 on January 30th. In 3 weeks, it's recovered 22%. And I want you to notice something important about the recovery pattern. Silver crashed 50% in one day, and it has been grinding higher every single day since. That's not the behavior of a bubble that popped. That's the behavior of a market that was artificially crashed and is now reverting to its real price. Bubbles don't recover in straight lines. Engineered crashes do. The pattern tells you what happened. And here's what's driving the recovery beyond just the price floor news. The fundamentals haven't changed, not one bit. The 6-year supply deficit is still running. COMEX inventory is still at 98 million ounces. Shanghai premiums are still 20%. Chinese markets were closed for New Year and are about to reopen. The delivery rate in February is still 98%. Nothing that caused the crash addressed any of these structural problems. The crash was a band-aid on a broken bone, and the bone is still broken. The price floor changes the game because it tells miners to invest in new production. It tells industrial buyers to secure supply before the floor kicks in. It tells investors that the government has their back. And it tells the shorts that the floor is being built under their feet while they're standing on the wrong side of the trade. I've been covering this market daily on finance currency, and I can tell you the sentiment has shifted completely. Before the price floor announcement, the narrative was silver crashed. Therefore, the rally is over. The mainstream media was celebrating. The shorts were taking victory laps. After the price floor announcement, the narrative is becoming the U.S. government just confirmed that silver is underpriced. Those are two completely different stories. And the second one is the story that moves capital. So the next time someone tells you the silver rally is over, ask them one question. If it's over, why is the U.S. government building a price floor for it? I would love to hear their answer. And here's the piece that ties it all together with everything I've been showing you on this channel. The volatility index for silver options hit 115. That's higher than the all-time high. The options market was telling you something massive was coming. Now we know part of what's coming. A U.S.-backed price floor. Hecla confirming the real price is far above paper, and 35,000 in the money calls approaching first notice day. The Fed is injecting billions in emergency liquidity. JP Morgan is short thousands of tons. Wall Street strategists are calling gold a bet on America's failure. And then the U.S. government turns around and builds a price floor for the exact metals that narrative was trying to make you feel ashamed for owning. The government is betting on silver with 55 countries at the table. While the media was telling you that buying silver makes you crazy, you cannot make this stuff up. When the most informed people in the silver industry are making the biggest bets of their careers on silver going higher, what does that tell you? When miners are selling gold assets to buy silver exposure, when the government is setting price floors, when industrial buyers are paying 30% premiums to get metal directly from mines, every signal is pointing the same direction. So here's my assessment. The U.S. price floor is the most bullish policy development for silver in my lifetime. Hecla's 30% premium proves the physical market has already separated from paper. APMEX's month-long shipping crisis proves physical demand overwhelmed the entire dealer infrastructure. And 35,000 in-the-money calls prove the January crash failed to achieve its objective. Gold at 5,000, silver at 78. 9 days until first notice day. Chinese markets reopening February 24th. A U.S.-backed price floor in development. Industrial buyers paying premiums directly to mines. And the largest silver producer in history just had the best year in its 135-year existence. This is my opinion, not financial advice. Do your own research. Make your own decisions. But every piece of data, every government action, every corporate filing, every market signal is pointing in the same direction. The price of silver on COMEX is not the real price of silver. The real price is what Hecla gets from industrial buyers. The real price is what Shanghai charges for physical. The real price is what the U.S. government is about to set as a floor. And all of those prices are much higher than what your screen says right now. You can print contracts, you can crash prices, you can write letters saying shipping is back to normal, but you cannot print silver. You cannot manufacture 135 years of mining expertise overnight. And you cannot unconfirm a U.S. government price floor once it's been announced to 55 countries. The floor is being built, and silver is standing on it. Drop a comment and tell me what you think the U.S. price floor means for silver prices. Where does silver go by the end of 2026 with a government-backed floor? I want to hear your number. I'll pin the best responses. Share this video with one person who doesn't know about the price floor yet. Most people have no idea the U.S. government just told 55 countries that critical mineral prices are too low. That single fact changes everything. If you're not subscribed to Finance Currency, hit that button now. This channel exists because nobody else is reading APMEX CEO letters. Nobody else is digging into Hecla's realized price versus market price. Nobody else is connecting a J.D. Vance speech at the State Department to what's about to happen on February 27th. I do this work every single day so you don't have to. And if this video helped you see something the mainstream media isn't showing you, subscribe and I'll keep showing up. This is Finance Currency, and I'll see you in the next one.